G'day everybody, Jason Foss here from the Capricornia Chamber of Commerce, here with Tony Edwards, Evans Edwards and Associates. It's been a couple of years since we did this, Tony, isn't it?
It has
been,
been,
of a
Jason.
Budget review, yeah. I don't know what's happened the last couple of years, but anyway.
We haven't got any older, I don't think.
No comment at all. And Tony's been good enough to make some notes here for us, and I like the title of what you've written here, Moving On from the Federal Budget. And of course, when it was released, there was quite a bit of discussion following that release, and it's ongoing. But just looking at your notes here, Tony, so we've got three main questions or three things to consider. Well, if we were to break it down into three things, what were you going to say?
Yep. So I guess the three most important things that are going to impact on everybody, but particularly business people, but one is the family trust changes, the family discretionary trust changes. The second one is the negative gearing restrictions. And the third one is the changes to capital gains tax, which is quite major.
So the first thing you mentioned there, Tony, is the changes to the family discretionary trust. You mentioned they're still under consultation, so I guess a lot of this is pending, but based on where things are at now, what's going on there?
Yeah, sure, Jason. I think it's pretty clear from all the changes that have been made to the family trusts that neither the government nor the Treasury nor the tax office like family trusts. They do all that they can to hit them over the head every now and then, and they've given them a really good whack this time. They're proposing to impose a minimum 30% tax on all profits from family trusts. Mm-hmm. And fortunately, the tax paid by the family trust will transmit across to individuals who receive trust distributions out of a family trust. As important is that the tax paid by the family trust will not transmit across to a company, only to individuals.
Right.
So therefore, the message in that is that companies will be double taxed if they get a distribution from a family trust. There will be the profits taxed at 30% in the family trust, then the profits in the company will be taxed at another, either 25 or 30%, depending on what applies to that particular company.
Yeah.
So double taxation, which means
that's interesting. Yeah,
there's not going to be the ongoing use of what are commonly called bucket companies to receive distributions out of family trusts. Okay. They're all going to have to go across to individuals, taxed at individuals' marginal rate, with a credit for what tax has been paid by the family trust.
Right. Okay. So they're definitely trying to kind of get rid of those bucket companies, as you call them there.
Without doubt.
Is there many businesses affected by that, or do you see that often?
There'd be lots.
There'd be plenty?
Lots and lots of businesses would be affected by that. Because when profits, under the current legislation, when profits are transferred across to a bucket company, then that company pays tax at either 25 or 30 cents in the dollar on those profits. Whereas if those same profits go across to an individual, they're going to be subject to individual rates of tax, and 9 times out of 10, those individual rates of tax will be higher than what the company rate of tax is. So that's going to have a major effect on a lot of businesses.
So I suppose there'll be a lot of accountants there with quite a bit of a workload in changing a lot of those structures to sort of, deal with that.
There will be, unfortunately. And I guess, as I always say, I'd much prefer to be spending my time helping businesses make more profit rather than just compliance and trying to get around the rules. We do have to try to get around the rules wherever we possibly can. We've also got to make sure that our advice is as profitable for our clients as what it possibly can be.
Of course, yeah.
Yep.
So the second thing on your hit list there, well, not that it's a hit list, but the second thing on the consider list is negative gearing.
Correct. So, as you may have heard, the government has restricted the ongoing use of negative gearing for properties purchased after the 12th of May 2026, which was budget day. Mm-hmm. Properties that were owned prior to that still retain the ability for owners to claim the loss against their other income, which is what negative gearing is all about.
Yep.
But any property purchased after the 12th of May 2026 is not eligible for the loss to be claimed against other income unless it is a new build.
Right.
New build
They're
premises.
Yep.
And this only applies to residential premises, doesn't apply to commercial premises. So negative gearing is still allowed for the purchase of commercial premises.
Is it? Okay.
Not residential premises.
Right.
So it's a fairly major change because there's been an awful lot of investment in residential property. A lot of people have used that to fund their retirement over many, many years.
Yep.
As a result, there's probably less. I guess as a result of the confusion, there's the property selling market has declined a little bit, but I think that's going to be a temporary blip because not everybody negatively gears their properties when they buy them.
Yeah, that's right.
If they're not negatively geared, it doesn't impact them at all.
If if new builds are exempt, do you feel that might place increased demand on new builds, possibly push new like the price of new builds up potentially?
Oh,
that's where the investment dollars go. Yeah,
without doubt, which is crazy because the government ostensibly wants houses to be cheaper so that young first home buyers can buy them. Well, I cannot for the life of me see how this particular change is going to make anything cheaper.
Yeah, and in fact, it could go the other way.
Yeah, I reckon it will go the other way, Jason. I do. Firmly believe it'll go the other way.
Yeah, okay. Now, the third thing on your consideration list is capital gains tax.
That's correct. So this is a major change. It's going to affect everybody. It's not going to affect just rich people. It's going to affect everybody because they're talking about replacing the 50% discount before people start paying tax on a capital gain with a, what would you call it, a 30% tax on real gain, and the real gain is the gain above CPI indexation over the period that the property has been owned or the asset has been owned. It doesn't just apply to property, it applies to all assets.
That's right, yeah.
So they have fortunately grandfathered the 50% reduction to the taxable capital gain to any properties sold pre-1 July 2027. So if you sell an asset pre-1 July 2027, you're still eligible for the 50% discount.
Yep, okay.
Unless, of course, you've bought it subsequent to the budget.
Right.
Bought it subsequent to the budget, but you still sell it pre-July 2027, then you're not eligible for the 50%. And the other big hit that they've introduced with this proposal is that they've deleted the exemption from capital gains tax on the pre-CGT assets that people might own and sell.
Right.
So capital gains tax commenced in September 1985. Assets that were owned prior to that, if they were sold subsequent to there was no capital gains tax to be paid on that. They've now scrapped that.
Right.
And they've said, okay, if you sell a pre-CGT asset after July 2027, then you're subject to the new rules and you don't get that 50% exemption. However, there is a mechanism that they've put in there, and that is that if properties or assets are owned as at 2027, not sold, then you can get a market value of that property at 1st July 2027. The increased value of that property from when you bought it up until July 2027
it's starting to get complicated, isn't it?
It's not simple. It's not straightforward, unfortunately. So the value that's been gained pre-July 2027 is taxed under the old rules.
Right.
The increase in value after 1 July 2027 is taxed under the new rules.
So how's that determined? Does everything kind of need to be valued at that rate?
Pretty much.
Yeah, okay.
Yes.
What,
So
so
the
valuers are going to be busy? Holy moly.
right.
Yeah, they're going to have a lot of work to keep up with.
It extends to so many things. It extends to the value of a business. It extends to the value of shares. It extends to the value of properties. So nothing is exempt from that. There's still some consultation happening around how that would impact people who start up a business where they might have not much money invested in the start of the business to create a cost base.
But a lot of IP potentially.
A lot of it is blood, sweat and tears that's gone in to build up that business. So there's some consultations happening around that, but government's playing pretty hardball on that. They've made some concessions, but the concessions they've made are nowhere near effective or good enough.
That's going to get really... I mean, shares are probably easy enough to, at a date, figure out what value they're at, but in terms of a business or something like that, like how are you supposed to figure out what that's worth at a certain date in time?
It's got to be valued. It's got to be valued. So business valuers are also going to be quite busy.
Wow. What other sort of implications can you see coming out of these new rules here?
Well, I think people are going to think twice about starting up businesses, and there's certainly been a lot of commentary about people who are starting up likely high growth, high value businesses, actually not starting them in Australia, going overseas, going to Singapore, going to the US, going to other countries.
I believe even New Zealand put their hand up and said, we've got no capital gains tax here.
They have no capital gains tax in New Zealand. So New Zealand might be a major beneficiary of it as well, given that it's a relatively similar sort of society to what Australia is.
Yeah, culturally very similar,
So I think it is going to drive some people offshore, which is going to be to Australia's detriment, because at the end of the day, Australia runs on employment in small business. So I think it's very much an own goal as far as the government is concerned, and as far as the revenue is concerned. So it's...
and it's going to be a very complicated thing to sort of then implement and manage. And as you're saying, like everything's going to have to be sort of valued at that certain date. And if it's not, then how do you... Yeah, okay. I can see a few issues. Yeah, a few issues there.
Yeah. So valuers are certainly able to go back a year or 2 years or something like that and say, right, well, we'll assign, based on what all the sales were, we'll assign the value, a value going back a couple of years.
Sort of to an estimate.
You might need a valuation come 2029 as at 1 July 2027.
Yeah, okay.
You might sell it in 2029 or 2030 or something like that.
Yeah.
But it's still going to be a massive impost and a cost and an administrative burden on everybody.
Alrighty, Tony, that probably just about wraps it up. Did you have any sort of final thoughts or...?
No, I guess I'll just repeat what I said earlier, Jason, that it's so important for everybody to consider which of these, or whether all of these apply to them, and their own impact on their family's wealth, and think about it deeply. Go and get some really good advice so that you can plan ahead, because planning is everything.
I was thinking that too. So not only this will, potentially affect your future wealth, because a lot of people are using these for retirement plans and whatnot, but it's all the extra administration burden as well, or the administrative burden, and as if small businesses don't have enough admin, here's some more. Merry Christmas. So I think that's really good advice. Go and see somebody trustworthy early as you can to get ahead of it.
Absolutely.
Yep.
Absolutely.
Alrighty, thanks again, Tony, for all that advice. We'll have to try and do this more often than once every 3 or 4 years, or however long it's been. Can't rush these things, can you?
That's fine. Yep. No, enjoy it.
All right. Thanks, everybody, for watching. We'll see you next time.
Thank you. Goodbye.